G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Please be sure to check out my links below, including exchanges I use and social media content that I post. All right, let's go. So the topic for this video, we're going over the upcoming rate cuts expected on the 18th of September, okay, the meeting date, and what the probabilities are and how they've changed, and look at some other things on Twitter, some economic data, some charts, and then my own charts on TradingView. So yeah, we'll talk about all different things, but mainly to do with the Fed interest rate cuts, which is coming up in a couple of days' time. All right, so very, very soon. First cut in a very, very long time. All right, since the 2019 rate cuts. All right, in the banking crisis, the repo market was imploding, and the Fed had to cut rates to stimulate that market. And we haven't had cuts since then. So it's been 5 long years since we had rate cuts. Okay, so the CME Fed Watch tool we are on at the moment, it says that there is a 59% chance of a 50 basis point cut and a 41% chance of a 25 basis point cut. Okay, so not long ago it was the other way around. It was more likely for a 25 basis point cut. It was like the 75-25. I made a video about that. I think I was talking about the probabilities back, I don't know how many videos ago, but I remember seeing it was well in favour of 25 basis points, and then slowly it's just come back in line, and now you can see the 50 basis point cut is more probable due to we had some CPI numbers come out, and the core was month over month numbers were slightly hotter than expected. I think that's probably what freaked out the people, and not seeing a 25 basis point cut. Well, that was, because of hot inflation. And the 50 basis point cut, well, you wouldn't want to cut if there's hotter inflation. So it's not, that wasn't the reason, okay? And the actual CPI year-over-year numbers come down a lot, so that was meaningful. But yeah, the core month over month rose. And yeah, I think there's a really, I don't know what the goes with these rate cuts and why they've gone back up to 50 basis points. Maybe there's people in the bond market know something we don't know, or the economy is not as good as what they're saying it is. But yeah, anyone can guess. We don't know, but we had to hear from the Fed in regards to their reasoning in a few days' time, a couple of days' time. But it's about 4 a.m. in the morning on a Thursday morning here in Australia to find out. But yeah, the odds are 60% chance versus 40% chance essentially, which is quite interesting. It just flipped from 25 to 50 now. So they're all starting to flip their tune. But I still see a 25 basis point cut coming in. All right. And I'll show you why in my charting on TradingView. Okay. So yeah, that's what I see for that one. Okay. And we have a bar chart. Tweet: caution, stocks are not entering the worst 2-week period of the year. So this is the median 2-week S&P 500 return since 1950, and it says in September that we are bearish on average, which we are. It's more of a historically bad month for stocks and crypto as well. So you have to wait and see for that. So that's a sign that going back a long time ago that we can see that the seasonality isn't favourable for the stock market at all. And that's just that one there. We also have capacity lit up, breaking the Restaurant Performance Index. RPI fell minus 1.3% in July to 97.7 points, the lowest level since the 2020 lockdowns. The index tracks the health of the restaurant industry by the US, measuring sales, customer traffic, labour, and overall business conditions. Since 2021, this metric has fallen by 8%, marking the largest drop since it was launched in 2002. Such a low level in the index has only been seen during recessions. All right, so you see they're pulling back, and food prices have increased by 27% and fast food prices have jumped by 31%. And eating out is officially a luxury. Yeah, that's right. And you can see it goes pretty meaningful below this 100 line, and it crashes down. And we see a big decline in their recession, 2008 and 2020, of course, with that recession. Big sharp drop. And now we're seeing it decline pretty rapidly. And from the top, you can see it's just falling off a cliff. It's really nose diving at the moment, heading below 98. And you can see recessionary periods occur around this level. And we're seeing a slowdown in the restaurant index there, which is not good to see. As obviously inflation has hit people hard, and they're cutting back on eating out. So that is that chart. So interesting to see. We have another bit of data from China this time. Just in, China August unemployment rate rises 5.3%, estimated at 5.2%, and previously was 5.2%. So it goes above the estimates and above previously. So we can see rising unemployment, not good. China retail sales rise 2.1% year over year. The estimates were 2.5%, but the previously was 2.7%. So a big drop off in retail sales. Another bad sign. And another third data point here, China industrial output rises 4.5% year over year. Estimates are 4.7 and previously was 5.1. Another downward miss. So 3 misses. Bad for China. And they're a big powerhouse. It cannot be ignored in the global economies. So I think they're the second biggest economy in the world behind the US. And they're it's very interesting to see China slow down, and its inflation very low. Their inflation's right on track for stimulus and for the economy to turn around and government to start stepping in and fixing things. But you're seeing rising unemployment, sales not rising enough, and output not rising enough is not good. And I think China and the rest of the world as well, it's you're seeing rising unemployment everywhere, but inflation is seemingly dropping everywhere in the world. Okay, but you're seeing these numbers come in China, and that's not a good sign at all. Okay, because they are the second biggest economy in the world. We have J.P. Morgan's Jamie Dimon, good old Jamie Dimon, reiterates its call for a 50 basis point rate cut this week. What are your thoughts? So he's saying 50 basis point cut, as he sees this recession going to be pretty bad. He was talking about how we could see inflation rise again and stagflation could emerge. But he's pretty much a full-on optimist, I should say, forecaster. He throws his wild predictions out there. Usually it's not that favourable. I wouldn't take this grain of salt pretty much. Nothing to be worried about. The biggest bank in America. This guy, I don't know. I wouldn't trust his opinion. If my life depended on it, definitely not. He's been wrong a lot too, and they have mixed results. And anyone could say 50 basis point, 25 basis point. We don't know. Some banks are saying 25. I think most of them are saying 25, so on the safe side. But 50 basis point could come out of nowhere. We don't know. Yeah, it's only if things are really bad, but I don't see it happening quite soon. I think 25 and then 25, and then potentially another 25 basis point cut. We'll see how things occur, and the economy and the GDP numbers coming out later in the month too, which is very crucial. If you get negative GDP, and then I think the Fed's going to start cutting it more aggressively. That is that stance, and where we are on that one. So we're on TradingView now, and this is the US 2-year yield, okay? And you can see I've got this measurement and this line here. This is the federal funds rate, okay, where it currently stands at 5.25 to 5.5%, okay? It's where the target range is. It's been flat since July of last year, and they're just about to cut in a few days' time. couple of days' time, roughly 2 and a bit days. And will it be a 50 basis point or a 25 basis point? And look at the bond market to see what really occurs. Can you see how closely correlated these two are? I made a video about this previously. See how correlated they are. Very, very correlated. That moved perfectly in lockstep, but you can see they are fairly married to each other. It's definitely, yeah, it's definitely notable. The Fed control the short end of the curve. 2-year yield reacts to what the Fed does quite often, and the 10-year or so is not as reactive. Okay, they got less control over it, way less control than the 2-year, which is closely tied to the Fed funds rate. And what we can see is from the very top, I've measured 32% down to where we currently are. And yeah, and the reason I measured that is I'll show you the previous rate cutting cycle in 2019. You can see right when they cut rates, the bond market fell from the high to the low. 42% yields just fell. And bonds rallied, of course, because they're inversely correlated. And when they fall, the 42% think that's a really bad drop. That's nearly half its value in yield terms. And that was only from 2.5 to 2.25. So it was only a 25 basis point cut, even though we had a 40% drop in the bond market or 2-year yield. You go back to 2006 to 2008 financial crisis, right? And from the very top there, you can see to the time where they cut rates, it was only 27% drop. Okay, and they cut more aggressively here. It was a 5.25% down to 4.75%. So it was a 50 basis point cut, and the drop wasn't as significant as this time here. That was way more significant. All right, you can see a big drop, but the cut was less aggressive. Okay. Right, and then we have the .com bubble in the top there in May 2000. All right, down to here when they cut rates, you probably can't see it very clearly, but right in between this line, there was a cut there going from 6.5 to 6, right? So the 50 basis point cut, first cut, and the bond market really fell 30% yield terms. We have another one here in 1995. There's a soft landing happened here. It wasn't a recession, but nevertheless, it was a cut happened here. So the bottom was 28% when they got their cut, and it was 6% down to 5.75. Yeah, so it was a 25 basis point cut, all right? And it was it went down 28%. Okay, so yeah, then we got this one, 90%, and the bigger cut was here, and that was 9.65 down to 9.25, so 40 basis point cut. All right. So we got mixed results. Okay. So I'm just showing you right there. Some dropped by 50, the Great Financial Crisis, and some only dropped by 25 basis point. And that was a 50 basis point, of course. It was a bad recession. And yeah, this one here in 2019 was 25 basis point, even though it dropped a lot more, 42%. Okay. And now at 32%, and it's just breaking this support level, as you can see here from this line, and it just keeps dropping. Okay. It doesn't determine how much the Fed cuts. Okay. The bond market's dropping like a rock. But yeah, it'll be interesting to see if it's going to be like 2008, 2001, 2000, you'd say, .com bubble, and they cut aggressively straight away, right? And then the panic starts kicking in almost immediately. The stock market doesn't favour very well after the big cut, or the short cut, the small cut, 25 basis point will not freak the markets out too much. I don't think they're going to do a 50 basis point cut. Another reason why you can say they don't want to do it is it's going to cut very slightly is the elections are on, all right? So they want to affect the elections too much, interfere. So the cuts are going to be very small and incremental and planned, and 25 basis point seems more likely in that front, okay? Now after the election, they have I think around the time of the election, they have another meeting to cut, and where they cut slightly again, just so they don't freak the markets out, okay? Keep the markets nice and high and not just slam rates, right? 50 basis points at a time. All right, so that is another reason you could look at too for why they're going to do that. And so today, we also got Bitcoin dominance at 58%. As you look up to here, and you see the wick high was 58.06, as you can see there. So you get a 58% region. It's got hits, and we've got a lot longer to go. Oh, really pretty close. Looking at it now from the bottom, the bottom was around 39%. Now we're at 58. I'll get 60 and 63 is my target. Okay, and that basically is just the Fibonacci from the top wick here down to the very bottom wick. If I can get it done properly, and the 6.8. Okay, the golden ratio, and around that box is a little bit higher, but in its vicinity, I'm looking at this being over, but depends on the balance sheet of the Fed when they start buying up bonds and stimulating again with their QE. All right. So the balance sheet is crucial to market top in dominance. So you can see there, it was top in QE back in 2019, and obviously way back here, but you can't even go back further enough. Okay. Started way before that. QE was happening a long time ago before that. So the great financial crisis, I believe. And we are tracking pretty strongly. The uptrend is pretty nice. Nothing to worry about there. It's just look at the candles. There's no reason to be panic if you're a Bitcoin maxi. Stay Bitcoin invested, especially in these uncertain times coming up, and the Fed rate cuts are coming. I would stick to Bitcoin over the alts for sure. And we see ETH Bitcoin, and this is another one. ETH Ethereum versus Bitcoin, and today with this candle. All right, we go to the daily. You can see it was pretty much yesterday and today, so 2 days, and we're in this box now. Okay, the target range, what I've set myself for it to hit, and we can go even lower to the 0.035, but we are at 0.039, okay? And this just lines up with this trend line, okay? Sloping over time from touching it here in 2015 and then 2019 and then came back to it again, okay? And it's also, if you look at this bottom here it's all right, there it is. So if you go from the bottom in 2016 and measure it from the bottom in 2019 right there, you get 120% rise, okay? In difference, and then you got the 2019 bottom, right? Measured to where I look to see it heading to, it's 120%, right? At the bottom of this box, and being the same as this one, same projections, and it looks like it's lining up, but the bottom will be definitively in when we get QE, okay? Right, see, it's very close to the bottom. And that's the Fed balance sheet, right? I mentioned it in previous videos. I want to mention it again, but it's interesting how the Fed pivot when they cut and they stimulate with QE, and then things start to shift positively. But I don't know if they're around that. It's going to come very soon. To wait and see for that one. And lastly, Bitcoin USD, and we've been trending down, of course, and we had this resistance line 61 where we've touched it several times. 1, 2, 3, 4, 5, 6, and rejected it again. Right. So that is pretty bad to see. And the trend ribbon, as I can show you, is still bearish here. And he's trending down, down, down. If you go to the weekly, it's been a bit green slightly here, went above it, but it's been red majority of the time since mid-June. It's been trending down with lower highs and then lower lows. Let's break this low really to go lower. And I do see it going down to 51K and then inevitably going down to 41K, okay? As recession kicks in, it's not going to be good for Bitcoin. And you got to wait and see at the oscillator's point. And this is looking to be oversold, so it could get a bounce. But, it crossed here. It just went down, it just faded down. Even though we crossed here, went oversold in July 2022, it still went down, okay? So anything could happen. Doesn't have to go bullish. Went down the bottom here, we got really bullish. And same here in 2019. That was the bottom. Boom. Here. A little pump, and then bam, sold off. So it doesn't really matter, this going oversold, crossing back up. It's more or less, it's the outlook of the Fed, okay, and the uncertain times coming ahead. Let's see what they'll do in response to this recession. It's inevitable. It will come, and will it be short-lived or long-lasting? We have to wait and see. This could be the end of this cycle. Hope not. I really hope it's not over. I'm not saying that at all. Hope it goes in 2025, the end of the year. You know, it's what this red line here, 200K top drawn. And usually in the post-halving year, that's when the tops are in Bitcoin, you know. So the top here was the post-halving year, and it was the end of that year. You know, it was Q4, it was November. Same as here, in 2017. That was the top December that year, okay. And we got 2013, right at the end of the year, December, okay. So yeah, I don't think it'll top now, and it's a low bear market time. I don't think the top is a lot higher than here, and it's around probably 200K-ish, okay, 200,000 or so. But yeah, we're a ways from that yet. Another year or so, or probably longer. We could go into 2026 if this recession does last a lot longer than expected. It really depends. But as you can see, right now, it's not looking good. We're about to cross on the monthly. MACD, it's crossing bearish. And every time it's done that, you can see it crossed here. It did go higher a little bit, okay? And then sold off. All right. Happened here. All right, around there. And then we just sold off. Bear market. All right. Happened here. If we go on a different chart, I'll show you a bit better on a different chart. Apologies for that one. So cross back in 2013. Okay, it was right around there. And then boom, we had a big bear market. As you can see, it went from $450 down to 168. All right. Crossed here, as I mentioned. Then it went down a fair bit. And then it crossed here. But went up and then down. All right, as you can see, the 3 times there, the cycles. More easy to see on this one, more long-term time frame. It picks out the early stages of 2009 when Bitcoin was really launched. And yeah, we're having to find ourselves in this scenario again. Okay. But yeah, we're getting lower highs and it is trending downward. All right. So diminishing returns, as you can see. All right. And this MACD goes lower. We hope that this is not the end, and then we go into a bear market, and then boom, and that's it for a while. Because I haven't invested my money yet, and I want to get into this market, but not yet at all. I haven't seen these my strategy hasn't flashed yet, and what I want to see to tick the boxes hasn't occurred. So, you know, we are still in an uptrend. This green trend ribbon in the monthly, and it still looks bullish. You know, and you see it's bearish times, bullish times. Even had the pandemic drop, still was bullish. Still went to the upside. And the red was the bearish period. The green was the bull, as you can see there in that cycle, 2016 to 2017. And the red was bear. And then green, obviously it does last a long time. And we had a bearish period here, flat period in 2012, right? So that's another indication that we are still bullish. It is not over yet. And it could come and go bearish for a little bit before going bullish again. Or if it does crash hard like this, it can stay bullish. Anything can happen, okay? That's the trend ribbon on that one. And yeah, it is just a matter of time what you see the economy evolve into, and see risk assets like Bitcoin do, and the stock market as well, hold up in the recessionary time. All right. It's only experienced one recession, which was this bit here. All right. One recession there. See the drop, pretty significantly bad. So if I had one recession for Bitcoin, will this be a worse drop or just a subtle to the 25K range or to the 31K or so range? That could be a possibility as well. So don't rule it out. So I did say 41K was a short-term target. All right. But yeah, as it corresponds, if I bring out this with this upward sloping trend line, which you can see 1, 2, and then it comes up to here. Okay, and this cluster here, which is pretty significant, the Bitcoin spot ETF, and then that's it. That could be it, or lower levels. Anything is possible. Bitcoin. So yeah, that is my analysis. All right, guys, I hope you enjoyed this video. Just going over the Fed rate cut possibilities. And they have risen to favour the 50 basis point cut, about the 25 basis points, from 60% now versus a 25 basis point cut at the 40% probability. And it was not long ago that I did a video explaining that the 25 basis point cut was way more likely. It was like 75 to 25 against 50. Now it's changed right around. So it's very interesting how the probabilities are switched from, one to the other. It's don't go off it, don't bet on it. It's just it'll fluctuate, and the Fed will do what they have to do. Okay, what they are, you just can't predict these things. It's just a bit of fun to look at, and yeah, they might even not even cut at all. They might even cut, but I do seem to have cut at least 25 basis point. I think, because the city labour market is weakening and inflation is going down towards their target. So yeah, there's no excuses now for the Fed to start changing. And Powell did say at the Jackson Hole meeting that it's time for policy to adjust, which means rate cuts, okay? And we talked about other things and tweets. The restaurant index, this is going down pretty significantly, so signalling we are heading to a recession there. Less people are eating out. Looked at China's economy slowing down pretty significantly, not good, pretty bad. See that. Jamie Dimon sees a 50 basis point cut, so he's more bearish than bullish. Well, Jamie Dimon, he's a warrior, that guy. He's been through it all. But yeah, have to wait and see there. And we looked at the historical seasonality for the stock market, and it suggests that September is pretty bearish overall in the last 70 odd years, right? And looked at my own charts as well. Looked at the bond market, seeing that the big drops on the top don't really suggest they're going to cut more. The bond, the yields drop more than a certain percentage or something like that. It's all staggered. It doesn't matter. We had a 40% drop now. GFC and the .com bubble weren't as big drops. Okay, and 2019 was a pretty big drop. And then you got 25 basis point cut. So it doesn't predict the rate cut sizes at all, unfortunately. But the bond market, there's more to it than what you think. But yeah, looking at the charts, it doesn't suggest any significant predictions there. Okay, so I have to wait and see what happens. And yeah, look at some other charts as well. The Bitcoin dominance, seeing that we're hitting these targets and getting close to the overall goal for those ones before interesting things happen. But the Fed is the ultimate tool to get me into the markets, but not yet signaling from their balance sheet. This just still goes down, down, down. When it rolls up, back up, then altcoins will be more in favour than in Bitcoin. But I don't see it happening this year, probably next year sometime. And then you look at Bitcoin price as well, see where that is heading. And yeah, it's bearish for the short term. About to get across on the MACD on the monthly. But hold on, if you're a bag holder and a believer, it's not over. But I do see a peak, like you usually see at the post-halving years, okay, at the end of the years. And it's no different this time. Just this recession will be the telling thing to see how long that lasts for us to either hit that target by, like I said, 200,000 on the video or beyond. I'm not sure, but I'm just being conservative for Bitcoin in 2025. Going into 2026 potentially as well if this recession drags out a bit longer than expected. So you've got to take that into account too, because the average recession's around 6 to 9 months or somewhere in that range. I think 9 months or so is the average. I'm not mistaken. But yeah, if it's that long, then yeah, you get to give it the market's time to absorb the downward pressure and then a rise back up to recovery. And the Fed step in and save the day. They always do. All right. So if you enjoyed this video, please smash the like, comment your thoughts below, subscribe to stay updated. Be sure to check out the links below, and I'll catch you in the next one. Cheers.